setting up the foundation, the fundamentals. And then from here, like, what do we want to do? Do we want to pay off debt? Do we want to lend money? Do we want to invest money? Like, where do we want this money to go next?
The market has volatility. This is guaranteed. So you don't want to do one or the other, just all in. But when you start to mix these types of things, you can have a pretty strong strategy for retirement.
So by digitalizing your life insurance policy, we guarantee you a system that allows your beneficiary to 100% receive the death benefit.
No matter what, if I die tomorrow, nobody has to search for these policies. It's one place, and nothing gets lost. What's going on, everybody? Another week, another wealth webinar. Thanks for joining us. And not just another wealth webinar. This is the last wealth webinar of 2024. Crazy to think that, but you know what? Because of the way Christmas and the way New Year's lands, this is the last one. So we will not see any of you until 2025. How crazy is that? Well, not as crazy as what we're going to talk about today, because we are going to talk about a taxable investment today. And it's not even an investment. We're going to talk about a place to put your money that might be the best place we have found out of all the places, but we're talking only about dumping money in one time. So what we're going to kind of hit today is something that we've known about a long time. We just barely ever talk about it, if never talk about it. Well, recently for a client, we had a scenario where this topic came up. And we said, oh, we don't really do that because it creates a taxable event, or creates a taxable situation. So you don't benefit from any of the tax advantages. And they said, that's okay, because they were buying it inside of a trust. But now let me just kind of come over here, and I'm gonna break this thing down. When we have money from our income, we have to figure out where that money is going to go. And most of you put that money into a bank. So let's just talk about your savings, right? So a lot of things happen. Some of you will sell your house and you'll have some extra money. Where's that money going to go? Is it going to go into a bank? Some of you might go to the bank and get talked into doing a CD. Some of you might talk to your financial advisor and you might do a money market. So these are all just, I'm only talking about the guaranteed places, right? The places that have the word guarantee on them. I'm not talking about investing it. I'm talking about where it goes before you invest it, or where it goes to not have any risk. So these are all the different things. You sell your house, you get an inheritance, grandma passes away and leaves you a little money. You sell your car, you get a bonus at work. We are coming up on year end. So a lot of you are probably going to get Christmas bonuses or production bonuses. I mean, it's that time of the year, but all that money's got to go somewhere. So one of the things I want to hit is, no matter what we look at over here, and I'm just going to keep layering some things on, annuities, some of you might do annuities, but I just want to hit some of these. Number one, banks, CDs, money markets. I just did this morning on Wealth Webinar. Right now, if you search for the highest high yielding savings account, what you're going to find is you could probably get about 4.6%. And that's because T-bills, treasury bonds, right now, the banks can get about that kind of a return by buying a T-bill or a treasury bond. CDs, I've seen these all over the board. I've seen these anywhere between 3 to 5%. And money markets, surprisingly, are actually lower than the savings accounts. So the highest one I found was somewhere around 4.3%. Annuities, you can go out and you still can get an annuity 5+%. Okay. So when you're looking at this, if you're just shopping for rate, it's easy. You just do a simple Google search or give us a call. We're always looking for that because we do a lot of cash management for clients where we're looking for the highest guaranteed rates of return. But, a couple things we got to really look at is when we look at the bank or the CD and usually the money market, all of these come along with taxes. So this 4.6, 3 to 5% or 4.3 is going to be minus taxes, and then you're going to get your net yield, okay? Your after-tax yield or your after-tax interest rate. So we got to factor out the taxes. So what is your tax bracket? Are you 25, 28? Are you 40%? Like what is your tax bracket? You got to know that because that's going to determine what taxes you pay. Now, Folks that are in the higher tax brackets will often kind of look at annuities because annuities have a neat little feature that is tax deferred. Okay, so you get to kick the can on the taxes until you decide to take the money, and you can kind of do that for quite a long time. But that's the main reason people use annuities, is it's tax deferred. The other thing, these three, banks, savings accounts, CDs, money markets, also, if you pass away, they're probatable. Unless they're inside of a trust, that's a probatable asset. Where down here, the annuities bypass probate. So you got some neat features with these different things that we look at. Now, what we're talking about, and I want to be clear, we are talking about somebody that gets a windfall of money. They've got a chunk of money and they need to figure out where to go. We're not talking about systematic savings. I would never be talking about these with systematic savings. You know, I'd be talking about specially designed and engineered whole life insurance, which I talk about all the time. But let me just pause real quick. How many of you, now that we're almost at 100, how many of you are here for the very first time? Put first in the chat. I was talking to some of you earlier. A bunch of you were here first from Christy Van and various different sources. So we got Elaine here first. We got David, who we spoke to earlier. We got Frank here. We got Tim. Let's see. We got Elaine, Shirley, Jacqueline. What's up, Jacqueline? All right. Oh, Vorgas. Hopefully I said that right, but isn't that a cool name? You'll never forget that one. Shirley, Vorgas, Jacqueline, John. Awesome. Welcome, welcome, welcome. You know, I don't know how you found us. John's also here for the first time, but thank you for finding us and thank you for spending some time with us today. We'll make it worth your while. We do this webinar every single week. We have not missed one since, when was it, Stephen? 2019? 2019, I think we started these things. And the idea came from a book I read about a guy that created a webinar to sell his potato guns. And he went live every single week at the exact same time and did the same presentation. Now, this show has evolved. Now we bring folks on like Craig and various other people who you'll hear from at 2 o'clock today. We got a special guest coming on. Going to be talking about the future. So you all know about AI, you all know about blockchain, at least I hope you do. You're going to be hearing from somebody that is cutting edge on that, and we are involved with them because we also see a big future in blockchain for what we do, which is the infinite banking concepts. Okay, that is the #1 thing we teach, how to take back control of your money by teaching you how to become your own banker. All right, so with that being said, let's get back over here. These are all places somebody may or may not consider if they had a chunk of money. And remember, these are places where you would put that money before the money goes to its next place. Like maybe you want the S&P 500. Maybe you're investing in NVIDIA now that it's pulling back. Not giving investment advice or financial advice, just saying that's a stock that's been in the news every day. Whatever your investment is, it has to go somewhere first before you invest it. That's the place we're talking about today. But we stumbled upon this other aspect, and we've known about it for a long time, but we have never once even talked about it. And we haven't talked about it because taxes. We have literally kind of gotten a bit snobby. Craig, I would say we've gotten a bit snobby. You know, when we talk to our clients, we're always talking about tax-free growth of the internal cash value. We're talking about tax-deferred growth, tax-free death benefit, all these tax advantages. So when someone comes to us and shows us something and it's taxed, we're like, nope, we like tax-free. But you know what? We ran some math today. Actually, I don't want to say we, Craig ran some math today on what is the impact if we had to pay taxes on this vehicle that we're going to talk about. Now, I know you all probably can guess. We're going to talk about a life insurance product. It is actually a whole life insurance product. Yes, it is a specially designed whole life insurance product, but it is not the one we do for the infinite banking concepts. But I'm going to turn this over now to Craig, and I want Craig to kind of kick us off here a little bit. We got a couple slides so you can see the numbers, but we're going to kind of dissect a couple options here. So if any of you did come across a chunk of money and you were just wondering, what should I do with this? This is going to be a really worthwhile webinar. Or if any of you think you have money coming in 2025 and you're like, I don't know what I would do with it, this will be very important for you. So Craig, let's dive right into what we're talking about with single premium funding.
Yeah, and there's a couple other things I think it would be useful. Maybe you could draw them on the screen too, but just to set the table. So when we've got that annuities box, and that annuities box can be broken down into immediate annuities, deferred annuities. So let's talk a little bit about those before we jump into the discussion. And then there's qualified, non-qualified. And so for our audience, let's just talk a little bit more about what those options are, because what I'm going to do is weave in an annuity strategy with this single premium kind of structure.
All right. So you want me to do it, or you want to kind of
Yeah,
hit on
you go
that
ahead
real
and do
quick?
it, and then we can kind of jump into the rest of it. But I think it'd be good for everyone to just kind of know these different blocks that are out there and where they fit in.
I was so excited to just dive in. I just didn't even stop at this one. So annuities, okay, annuities are issued by insurance companies. You probably want to find a good, strong, I would suggest mutually owned insurance company that will issue your annuities if you're looking at it. But there are two types. There's immediate and deferred. The one I was talking about earlier in this box over here was more specifically deferred. So it's pretty easy to understand. If I took $100,000, because I'm just going to use a round number. If I had $100,000, windfall, or I had 100 grand sitting in the bank, and I was like, where do I put this? Well, you'd have to decide: are you looking to put it somewhere and let it grow, or defer that growth into the future, or do you want that 100,000 to immediately provide you an income stream? Well, in that, I just explained the difference between immediate and deferred. If I put 100 grand into an immediate annuity, that immediate annuity is immediately going to kick out an income. And it's going to pay an income for either your entire life until the day you die. It can actually supersede you when you die too, because you could do like a joint, or you could do a survivor. You could basically have it so this income pays out for your life. And then when you're gone, it could pay 50% out. It could pay the cash refund of whatever wasn't paid out. There's lots of options, but just know it's going to pay you an income. And that income is going to be derived by the amount you put in, plus a pretty darn good interest rate that you're going to earn on that money. They call it a crediting rate. A deferred annuity would be you put the 100 grand in the annuity, and the deferred means that 100 grand is going to grow tax deferred, okay, plus interest. And that interest rate right now, depending on and the reason I'm giving you a range, there's lots of different companies, and there's different ways you can do this. You can lock it in for 3 years, for 5 years, for 7 years. You can pick how long you want this money to just sit there while it grows. So I'm just going to put 3 to 5%. You might even be able to get 5+%. So that's the difference between immediate and deferred. Now we can go one layer deeper. Real quick, any questions on immediate or deferred annuities? You understand the difference, right? Just making sure I got it all.
Really
I want to come back to
how quickly you want how much you want the money out. Do you need it now? Do you need it later? So lots of options there.
Yeah, and if I could, while we get into this, well, we got well over 100 people now, and it'll keep climbing. If you have questions, like Brian Springs got a great question, pop them over in the Q&A, and we'll handle them, over there, either with an email back to you if it's just a direct question, or we'll just kind of address it live. I love that one, SPAXX, which is Fidelity's money market, currently paying 4.5, but coming down off of 5, and it will continue to go down. Hey, Stephen, real quick check: did Jerome Powell come out and drop interest rates yet?
I think at 2 o'clock.
Okay, so 2 o'clock, we'll actually do a live update on whether the Fed's going to drop rates. But my guess is, yes, they're going to, which means your little SPAXX paying 4.5 will probably go down again. But anyway, back over here, one layer I want to go deeper. If you understand the immediate and the deferred, income now or income later, or growth later. Now we've also got to go into qualified and non-qualified. This is a really important thing, because everything we do with the infinite banking concept falls on the non-qualified side. Also, your bank accounts are non-qualified. More than likely, if you buy a CD, it's non-qualified. Non-qualified means it is not a qualified retirement account. So all this means is you're going to pay taxes now in most cases, okay? So taxes would come in the form of a 1099 at the end of the year. And also, the money's liquid in most cases, not all. Qualified money, this is retirement dollars, all right? So qualified just means it's qualified retirement funds. So now what we do is we put some rules in there. One of those rules is 59.5. Now, I also want to preface that if we do an annuity, a deferred annuity, it is going to be non-qualified money or qualified. You could use retirement dollars and roll them over into an annuity, or you could use money in a bank account and put that into the annuity. But the one thing that's always going to happen with an annuity is it's going to still abide by the 59.5, 10% rule. Okay, so what does that mean? That means if I take the money out pre 59.5, there's a 10% early withdrawal penalty. All right, so this is the same thing with your IRA, your 401k, but if you put money into an annuity, a deferred annuity, it's going to still trigger this here. You're going to have to pay 10%, but it's not on the total amount like it would be in your IRA. It's just on the gains. All right, so qualified 59.5 rule plus it's 70.5, at least 70.5 now. You got to take required minimum distribution. So an annuity could fit into non-qualified buckets, and they could also fit in qualified, either one, immediate or deferred. So it's a nice solution if you've got an old retirement account, like an old 401k, and you're like, what do I do with this thing? I don't want to take any risk. You could roll it over into a deferred annuity or an immediate annuity if you wanted income. Okay.
Awesome.
How's that, Greg?
That is perfect. So just want to make sure everyone kind of had that base before we jump into the other pieces. So I'm going to go ahead and share my screen out here.
I got to hit this one, man.
Okay.
Tim Morgan in the chat said, my bank took the money, but put a month-long hold on it. Stephen, remember that other person we just talked to? They did something very similar. They deposited money in a bank account, just like a checking account, and the bank put like a exorbitantly long hold on the money. Like, we've been seeing this a couple times. So Tim, I'd like to hear a little bit more about that in the Q&A if you could.
Well, Chris, I can share a quick personal bank story. It happened to me last week. So in 2018, I set up a bank account just for my revocable trust. And you have to send your, give them your trust documents, all these things to set the account up. And last week I got a call from the bank saying they're going to freeze my money in my account unless I provide them my trust documents. And this was set up in 2018. And I thought, so you're just going to freeze my account until I can prove that this is a legitimate trust account. So we had a pretty interesting conversation. Turns out they lost the paperwork and then they found it. But it just blew me away that because of something they failed to do, they're going to lock up my account.
Sounds like a bank, man. Time for you to become your own banker.
I was like, oh boy. But so our topic today is really that single premium funding. And so we're going to run through a few different options, and Chris has already touched on some of these, but I just wanted to throw out there, you're going to hear these different types of things. There's deferred annuities, immediate annuities, qualified, non-qualified. Chris just did an awesome job talking about that. What we're going to be talking about is the single premium whole life insurance. And then I also want to string that into an annuity with a whole life policy. Now, for some of you out there, when you work with us, we're setting up whole life policies for the infinite banking strategy so that we can recapture money that we would otherwise spent with a bank, whether we're buying cars, paying off debts. But even within a whole life insurance policies, there's different structures. Has anybody heard of something called a 10-pay or an 8-pay? Just kind of curious in the comments. If you've heard of those terms, let me know, but I am going to go through and explain those a little bit more, the 7 pays. What they're talking about there is they're structuring the policy to be paid up in a certain time period. So let's say, for example, you've got a 10-pay whole life insurance policy. That means you're going to pay premiums for 10 years and then you're done. The insurance is fully paid up. There's no more money put in there. So if there's any questions on that, let me know. But just think of those different classifications. 8 would mean I pay for 8 years, 10 pay for 10 years. When we set up infinite banking, we're typically looking to pay those premiums for as long as we can, because guess what premiums equal? It equals more cash value. It means we have more financing we can do with our policy. So we want to do as much premium as we can, but today's webinar is really about those use cases where, like Chris said, somebody's got a lump sum and they want to put it into some sort of a vehicle to benefit them. So Chris, one other case I was thinking about is maybe a grandparent that has a lump sum and they want to gift a grandchild, maybe help them pay for college 10, 15, 20 years down the road.
We get that a lot. We get people all the time saying, hey, I just want to put money in one time. Can I do that? And up till this point, we've kind of always said you shouldn't, because why would you want to not put premium deposits in? Because it's all about the premium. That's how you make the money. But we never really considered that there might be a solution for that.
Yeah. And so, I mean, the way I would kind of look at that is, yes, infinite banking is awesome because we want to keep paying those premiums and have that financing for the rest of our life and that growth for the rest of our life. But as a grandparent, you might be at the point where, hey, I've got 100 grand available. I just want to plop that into some sort of a tool that grows so that when my grandchildren are ready for college, I can pay for college. So there's a lot of different use cases, and like Chris said, we just need to be a little more open-minded with, what is the problem you're trying to solve, and then bring these solutions. But anything that you see on this screen right now, whether it's different types of annuities, different types of structures of whole life insurance with different payment periods, all of those could be considered in what you're trying to accomplish. Now, Chris, you may recognize this video, but for our attendees out there, and I saw a question in there, I think you may have already answered it. Somebody was saying, hey, I'm already retired. What could I do with retirement strategies? And so, Chris, you did this webinar, and I loved this webinar, but you talked about concepts of volatility buffers, covered assets, and it was a strategy where you're taking some of maybe your 401k and you're converting that into kind of an income stream with annuities. There's all these different strategies of really managing some of that market volatility. So for those on the webinar today, there's a QR code here. If you want to see that webinar, I think if you're in retirement or considering how you can use some of your resources of retirement, take a picture of that QR code. That'll take you right to the video, but it was a retirement strategy session that Chris did on a wealth webinar.
That was a good one. That one took a lot of time and preparation to create.
Yeah. And it's just phenomenal because we're looking at all of in that video. What I liked how you kind of looked at all the assets that somebody had, and you could let's take some of the market risk off the table and put that into some guaranteed income strategies. And so take a look at that. So hopefully everyone's had an opportunity to grab that QR code, and we're going to move on here. All right, so the first thing we're going to do in our use case today is, remember how Chris was talking about annuities, and what we're going to use in this case is what's called an immediate annuity, and this is going to be a non-qualified. So we're not using retirement income. We've got a situation where we have $100,000. We want to put it into an income stream. So you'll see up here there's a premium of $100,000 just going into this single premium immediate annuity, as it's called. And as Chris was explaining, there's different payment structures and payment periods you can put on. In this particular one, we're doing a 10-year guaranteed period. So we're just saying, hey, Mr. or Mrs. Insurance Company, here's $100,000. I want a guaranteed income for the next 10 years. And what they'll do is they're saying in this contract that every year I will have $11,546.62 just coming to me that I can do something with it. Now, of that 11,000, Chris shared with you, there's taxes. And so what they're going to do is they're going to have an exclusion amount in these annuities, and they're going to show you what is kind of that taxable portion based on your tax. I think I did this one at 28% effective tax rate, but of that 11,000, about 1,500 of that would be taxable. So let's just say 433 or so of that is going to be taxable to you. But what you have in your pocket after paying taxes and getting your payment is a little over $11,000.
Dude, that's not bad. I mean, like, just think about that. And folks, this is 100% guaranteed. That's an 11% payout rate. Net of taxes, it's a 15% payout rate if you factor in the taxes. If I'm doing my math right, 100 grand giving you 50. Am I doing that right, Craig? Hold on. Let me.
Well, I mean, if you look at it on a per
yearly, yeah,
on a per yearly, yeah, I mean, you take the 11 divided by the 100, so somewhere in that range.
Yeah.
Yeah. But what are we going to do with this 11,000? Because what we wanted to be able to do is get that into a vehicle to grow and build, and so in this case, we're immediately annuitizing, if you will, building an income stream out of that 100,000. And so down here, I'm not an artist like Chris, but I kind of think in block diagrams. So we're going to take that 100,000, put it into this single premium immediate annuity, take a yearly distribution, pay our taxes, and then we're going to take that 11,000. And because we have 10 payments coming to us, well, why not do a 10 pay whole life policy, which means we'll have 10 payments of $11,000 going into this whole life policy. And after that, there's no more required, and it's just going to continue to grow. So now if this was a grandchild type of a situation, we're trying to build a college funding, well, maybe they don't need the money for 20 years. So really this money's got 20 years to grow, but we're only contributing for 10 years.
So Craig, I also want to hit one thing just so everybody's paying attention. So if you put 100 grand in, it's going to pay you roughly a little over $11,000 a year net of taxes at this shown tax rate. Your situation may differ, folks. And then you're going to take that money and you're going to put it into a tax advantaged vehicle, a 10-pay specially designed whole life policy, and let that money grow, which will also self-complete with a legacy. However, after the 10 years, Craig, they're still getting an income of $11,113.39 if their taxes stayed the same, right?
Well, so on this particular annuity, I just set it up to give me
so
payments for 10 years and then it's done.
Missed that.
Yeah. So to your point, if you wanted to structure it differently where we stretch it out, what that means is this annual income will drop a little bit. So, the longer we stretch it out, the less that income is going to be, but it'll be coming to us for longer. So if you wanted to structure it where you figure out how much you can put into the whole life, but you want to keep payments coming for 20 years, absolutely, you could do that.
Cool. I'm just doing my math over here.
Yep.
You make $11,133.90.
Yep. So these are really flexible on how you want to receive that income. And in that deferred strategy, you might defer it for 10 years and then turn on a lifetime income rider. It says, hey, if you live to be, 110 years old, they're still going to be paying you that income because it's a lifetime income rider. So annuities offer some really cool guaranteed strategies. Some people will look at annuities and say, well, I can do better in the market, but that's not the point we're making. We're saying the market has volatility. This is guaranteed. So you don't want to do one or the other, just all in. But when you start to mix these types of things, you can have a pretty strong strategy for retirement. So let's go take a quick peek at the 10-pay whole life. So remember what we did is we extracted 11,000 from the annuity for 10 years, and we funneled that into a 10-pay whole life insurance policy. And so what that looks like is essentially this. So you've got essentially 10 years of putting in 11,000, and even within the 10-pay policy. So this is a whole life policy from a mutual company. So we have dividends. We're participating in that growth. But although there's dividends, those aren't guaranteed. But Chris, thinking about all the companies we work with, I mean, generally speaking, they've all been in business for well over 100 years. How many times have they missed paying dividends?
Never once. They paid dividends every year, never missing one since inception.
But we can't guarantee that, but they've never missed one. I think about the bank holiday in the 30s. I think about the Great Depression, World Wars, and the insurance companies are paying dividends and banks are failing. So it's just another testament to how financially strong these insurance companies are. But what they'll do, so inside of this 10-pay policy, we have guarantees. So they will guarantee cash value and death benefit. And then if there's a dividend paid, it just gets better and better. So everything in the green are the guarantees, and you'll see that going down the line. But once they pay a dividend, this also adjusts up. But paying the dividends, that'll add to your cash value, increase your death benefit. And so everything just keeps getting better and better. But what we tend to look at when we're evaluating policy performance, and before I jump into this too much, one of the things we want to think about is when we're doing infinite banking, we don't necessarily care as much about the policy performance because we know it will long-term be beneficial to us. And it's a matter of capturing those dollars that we otherwise would have spent somewhere else. But we just kind of use this as a test point to see, can we make it more efficient? Can we make it even more efficient? But so what we're really measuring is for every dollar going into the policy, how much growth did we have that year? And in this 10-pay policy, we put in 11,000. We have a little over 8,000 in cash value, that year. So this kind of speaks back to some of that liquidity question that if you were to put 100,000 into an annuity and it's deferred, well, that it's not really liquid. What we're doing this way is we're kind of getting best of both worlds where we're putting some of that money into an immediate annuity. and we're building some liquidity inside of the whole life policy while it grows. Now, this is not a taxable, this policy itself is not taxable. This is a, the standard whole life policy that, we've got, we don't have that MEC condition, so we're not going to be taxed on the money that's in here. So I just want to make sure everyone understands that.
Yeah, and it looks like it's got a cash on cash efficiency point of year 3. So year 3, every dollar you put in past the 3rd year, you're making more than what you put in. And then it's got a cumulative break even in year 6, is that?
Year 6.
Yeah, year 6. So technically the way to look at that is if you put the money into the annuity paid out, you put all the money here, by the 6th year, you've recouped all of the money and then some on the original 100 you put into the annuity, plus you got a death benefit in this scenario. And listen, folks, your scenario will look different than this because this is based on a 46-year-old male, I would assume. So if you're a female, the numbers are going to be better. And there's a lot of factors, just trying to say that, your numbers might look different than these, but yeah, that's the case. So you've got a $300,000+ death benefit, and then it's going to fall off a little bit when we drop the term, but so it's not a bad strategy. I mean, you recoup all the money you put into the annuity. Now you got a legacy, and you got all the money in a tax advantaged account.
And so by the end of year 10, you've got about 124,000 of cash value. And now look at year 11 and beyond, you're no longer putting anything else into the contract, but yet it grew 5,450, then 5,670, and your death benefits going up, your cash value is going up. You've just got a money machine that just sits back printing money at that point.
And the other thing too, that we haven't even hit, and we're not going to really hit this, but if you applied the process called the infinite banking concept, and you took the money from the policy and you sent it out to work again, maybe private loans on Private Money Club, paying off debts, buying real estate, whatever, this money's liquid. You could take this money out as a loan from the insurance company. The insurance company would charge you an interest rate on the loan, but if you look at the 4th year, you made 6.7% on your money that year. So if you took a loan for the money you put out, if you took in the 5th year, I think my eyes are not doing good.
5th year, we're
4th year, do the 4th year then. You took out 106. I'm going to put my glasses on. Took out 106%, which means you technically made 6.7% on the money you put in that year. If your loan cost was 5 or 5.2, you make a spread. So every year from that point on, you're making money every year on the dollars you put in, even if the money's out working for you net of the cost of the loan.
Yeah.
That's another way where this money could work even harder for you.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Yeah, so it just gets better and better. And then Shane, I see, just asked a question. So he's asking about the 100,000 in the annuity. He's assuming that the money is used up as the 10-pay contract guarantee. I do not understand the whole life portion. So I'm going to go back one slide here, Shane. So what we did is we took that 100,000 and we put it into an annuity contract day 1, and then we created an immediate payment stream from it. So think of every year that annuity now is going to net out $11,000 into our pocket. What we're going to do is use that money for the premiums every year for the whole life policy. So in 10 years, this annuity is done paying us. And in 10 years, we're done paying premiums to the whole life policy.
Craig, you know what we should have showed? Somebody just in the Q&A asked a really good question. Could you do this for a child? Let's say one of you are, a grandparent, and you've got some money that you wanted to gift or give to one of your grandchildren, maybe for college or something. You could take that money, the lump sum, put it into that immediate annuity, and it would be even better because the immediate annuity is going to pay out more if you're older. So let's just say you're in your 60s or 70s and you put 100 grand in that immediate annuity, the payout's going to be even higher than what we showed. And then you take the income from the immediate annuity, put it into a policy that you own, but the insured is the grandchild. Yep. That would be a rock star. We should do that in one of these wealth webinars, because I think that would be wild to see. But if you like these numbers you're seeing here, if you did that for a child, as long as you could put that much money into it, because it'd buy a whole lot of life insurance, then it would be just wild what these numbers would look like.
Yeah, and the thing I really love about that approach is, what if you're a grandparent and you've got 5 grandchildren? So you build one annuity that feeds 5 policies.
Yeah, exactly. So yeah, have that 11 grand be split up amongst all the grandkids.
Yeah. Yeah.
And now it's money working for you. And then you're putting it into an account that allows your money to work for you a second time and maybe even a third time. All the while you're basically building up a nest egg for that grandchild or grandchildren. Phenomenal. I'll shut up just in the sake of time because we got a hard stop with our guest coming at 2, but we'll get into the next part, which I think is fantastic.
Yeah. So now we're going to shift into, instead of using an annuity and putting that payment stream into a whole life policy, we're going to go right into what's called a single premium whole life policy. Now, this is a traditional whole life policy, but we're making one payment. And guess what happens when we make one payment into the single premium whole life policy? Who can tell me what is going to happen from a tax perspective? Anybody in the comments know that 3-letter word or that 3-letter acronym? Starts with an M, ends with a C. There you go. Boyd got it, MEC. So what will happen is, for the new folks on the call, the IRS has a set of guidelines called a modified endowment contract. And it just has some rules about the funding of a policy in relation to the death benefit, and not to get into all the details, but if those guidelines are not met, the whole life policy becomes taxable. It becomes considered a modified endowment contract. So in this case, this that I'm going to share with you, this single premium whole life policy is a MEC. It will be taxable. Now, what are the benefits of doing a single premium whole life? Well, we've talked about some of this already. It's one payment. You've got the full coverage. You've got the cash value accumulation. You have access to the cash. It can be used for estate planning, these college types of situations we've talked about. But what I want to do is show you what that looks like in terms of the policy structure. Okay, so here we have a single premium whole life policy that is a modified endowment contract from day one. And what we're going to do is just put in $100,000 once. We're not going to put anything else in after that. You could structure it to put some more in, but in this case, we're just saying 100,000 is going in. I'm not putting another dollar in for the rest of my life, and I just want to see what happens to it. All right, so at the end of year 1, we've got about 96% cash on cash, which means for every dollar we put in, we have about 96 cents of that dollar available in cash value. And over time, we just see that grows and grows and grows. And by the end of year 10, and the reason I'm picking on year 10 is I'm showing you in that first strategy, I think we had about 124,000 of non-taxable. Now we've got about 142,000 that some portion of that could be taxable. All right, so when we look at that, we have to consider what is the cost basis. And what we mean by that is, how much have you put into the contract out of pocket? Well, that was the 100,000. So the growth or the gain is 42,000. And so assuming you have an effective tax rate of 25% and you wanted to withdraw this 142, I'm just saying, I'm going to take this money out and go do something. Maybe it's retirement. We are going to pay taxes and penalty on that if you're under 59.5. In this case, Bucky Doe, who we've built this for, would be 55. So not only would they have taxes, but they would have that penalty because it's before 59.5. But what I'm trying to figure out is, what is the net benefit? So take the taxes out of the equation, take that off the 142. We still have about 128,000 net benefit at year 10, which is still a little higher than using that annuity strategy into the 10 pay. So this is where Chris and I were talking, and we just thought, this isn't that horrible of a situation, because even if we did the annuity to the whole life, or going straight into a single premium whole life that's taxable, it's a modified endowment contract from day one, we still have a little bit of net benefit here over the two strategies. So this is kind of where we thought maybe we should be a little more open to using this as a strategy for those edge cases, not for the day-to-day stuff we do for infinite banking. So Chris, I don't know if you have anything to add to this one.
Sorry, no, somebody from the office was trying to question my mathematics skills. So I had to get him wrong and slap him around a little bit and tell him, cash on cash is the amount of return you're making on the money you put in that year. Anyway, back to this. No, I don't have any comments.
Yeah, so let me know in the Q&A comments if anyone has any questions on this. But this again was really just a second option. Instead of doing the annuity to the whole life, we're just going straight into a modified endowment contract, single premium whole life policy. And as you can see, there's a little bit of net benefit to doing it this way. It's not always going to be the same. Your situation could be a little bit different, but we just wanted to show that it's not some horrible situation that really gets you into the point where you have a lot less money if you do this. So anyway, now even if you didn't take this out, this could continue to grow, and there's still going to be some taxes down the road, but it's all deferred. So what I want to do real quickly, just to answer, so I figured there'd be a lot of questions about taxes on this. We are not CPAs. We can't give a tax advice, but I can kind of share with you some of the differences in the modified endowment contracts. There's this concept of a 1035. So if there's other folks out there that have
IULs or VULs or universal lives that you no longer want anymore. Sorry, Craig, had to do it.
Yeah, and I'm glad you said it because I was thinking, well, should I say it? Yes, IULs, those are pretty common. When we look at those all the time, in most cases, people are sold a bill of goods on those. And so there are ways to do a 1035 exchange and put that into a whole life policy. So imagine, if you will, you took a 1035 exchange, you exchanged one IUL policy for a whole life policy, and as a big chunk of change, you could just put it into a single premium whole life policy. As long as you don't put any brand new money in it, it's not a MEC, and it will grow just like a whole life policy would. So option one would be 1035, an existing policy into a single premium. It would not be a MEC. Or if you do the scenario I just showed you, which is to put out-of-pocket money into a single premium, it will be a MEC. So now let's talk a little bit about what happens when you have a modified endowment contract. One, the cash value growth will be tax deferred. So it's not as if you're paying taxes every year like you would get in your bank account. You're going to get a 1099 from your bank every year. In this case, your cash value will be growing, but it's tax deferred. The second point would be, if you were to take loans, the way my understanding of this is as long as there's not a gain, meaning if you've put 100,000 into the contract and now you have 110,000, we have 10,000 of gain. That means your policy loans can be taxable to the extent of that gain. So there's some things to consider when you're using loans from a contract that has a modified endowment contract. There could be some taxable situations. And just like we talked about with the 59.5 rule, if you do withdraw money from the modified endowment contract whole life policy, there will be taxes to the extent of that gain. And so the one thing that's really cool about this, though, is the death benefit. So let's say you've got a named beneficiary on a modified endowment contract, that still goes to your beneficiary tax-free. So there's just some tax things to think about if you ever have a modified endowment contract. Chris, anything you need to add into that one?
No, I think this is the interesting part. We've always avoided this because we don't build MECs. For the infinite banking concept, we just don't build policies that are MEC status because we want to enjoy the taxes. But in this scenario where somebody just wants to put money in one time, they're looking for that legacy, they're looking for growth of their money on a guaranteed basis, and the death benefit is tax-free. Like, this is a fantastic strategy. And until we ran the numbers and netted them out, again, consult with your CPA for any tax advice for your particular situation, because not everybody's got an effective rate of 25%, but it just penciled way better than I thought it was going to, which is why I wanted to bring this into this training. And I appreciate you putting this together, because it was just, this is something we definitely need to be talking about more. More people are looking for this than we think. We get questions about it all the time, but now we're looking at it from a mathematical standpoint, taking the taxes out, and it still looks like a very viable source. Another person had a unique concept: put the money in, take the money out, put it into the annuity, and then have the annuity pay the loan interest to the insurance company, and then fund another contract, maybe even on a child. So you could layer this and ladder this a whole bunch of different ways. We're just sort of getting you started with the idea to get your brain wrapped around, like, hey, listen, there's all sorts of possibilities out there. But where you go from this single premium policy, you could do all sorts of neat stuff. You could reverse engineer it the way that we did the other one with the 10 pay, where we started with the annuity, went to the policy. Here, you could start with the policy, take the loan, go to the annuity, have the income from the annuity, service the loan on the policy, but then the difference funding another policy for a child, grandchild, or maybe just yourself. Interesting thoughts. And that came from a comment in the chat there.
Yeah. There's a lot of cool things we can do with this. And then Leah asked a question about the MEC. So not understanding what I meant by the policy loan below cost basis. So what we have to look at in a modified endowment.
You want me to just draw that, Craig? That might be the easiest thing.
Yeah, sure. And while you're drawing that, it's just really cost basis is going to be how much you've put in out of pocket. And then they're going to be looking at what's above that. And that's your growth that could be taxable. So Chris, can you post, do I need to quit sharing so you can see so everyone can see the screen, your screen?
Yeah, but you can finish these and then I'll just wrap
Okay.
up before our next guest comes
Yeah.
on. I'll just show the cost basis one.
So I've just got one more thing I wanted to show because as I was thinking through the strategy, we could do the annuity to the 10 pay like we showed. We could just go straight into a single premium whole life policy. But I also thought there's another strategy, and this one is not a MEC. So what we're doing is we're still putting $100,000 into the whole life policy. However, we structured it as 90,000 of it is a one-time dump in. So that's just taking 90,000, dropping in the policy. And then we structure a 10,000 annual premium. You don't see premiums going in anymore, but the way this policy is set up is that after year one, we start taking cash value and dividends to pay the base portion of the policy. So we're effectively getting the same thing. It's just not taxable. We have 100,000 going in the policy. The growth of the policy and the dividends are paying the premiums in year 2 and beyond. And I just wanted to see what it looks like. I wanted to run the math. So at the end of year 10, we're not quite at the point where we've got all of our money back, but there's about 99,000 in cash value. But you can see after year 10, it does start gaining progress. So another strategy, I don't know if this would be the one I would necessarily pick. I'm not a big fan of doing it this way, but I'll tell you one of the structures of why this came out of is, for those in the audience, if you've read this book, go to page 51. It talks about equipment financing. That's essentially what Nelson Nash was teaching in his equipment financing, is capitalizing your policy, say for 4 years, and then not putting any more new premium in. It's just premiums are being paid by the financing. But the way that was done is by using these dividends and any cash value just to cover the minimum on this policy, which the minimum on this policy would be around $5,000 to $6,000 a year. So it's just another option. And one of the things that, Chris, I think we just want to share with the audience is that we have a lot of different ways of doing things. And when we can have a discussion and clearly understand what you're trying to accomplish, we'll go back and do these different scenarios to figure out what pencils out the best. So we're just kind of sharing with you what some of those look like.
Yeah, that's what we've been really doing. Craig's been leading this whole thing. It's our advanced markets group where we do a lot of very unique planning for clients. Client will come to us with a unique situation. Like we did another training about 2 business owners that wanted to do key man policies on one another that we then roped in buy sell. So we're doing a lot of advanced planning for certain clients of ours, and that's where this stuff came from. So what a lot of you don't realize is a lot of the trainings we're doing are it's almost like a replay of the real life scenario. We just don't use the names. We change some numbers. Bucky Doe is our favorite person, although Bucky Doe is not a real person. But this whole planning module that you just saw, what we just showed you, is literally something we're actually doing for a real client. Which I think is very neat because all of you get to see something that's going to actually be put into action instead of just conceptual. And then the only thing that I think sucks about when we do these is it just leaves, well, it doesn't suck, it's good, but it leaves your imagination running because there's so much more to do than what we just showed you. Literally, we're just setting up the foundation, the fundamentals. And then from here, like, what do we want to do? Do we want to pay off debt? Do we want to lend money? Do we want to invest money? Like, where do we want this money to go next? And that's what really starts to increase your wealth. Because like when you look at these numbers, whether it's this example, the single premium, you know, the 10 pay, like, yeah, it's good. Like the growth is good compared to a savings account, a money market, a CD, or even an annuity. Like your growth is better by doing this. Plus you get the benefit of the death benefit. The thing you got to understand is there's a whole nother dimension that we're not getting into in today's training, the infinite banking concepts, applying the process that the late R. Nelson Nash pioneered in becoming your own banker. Like when we apply that process, whether it's buying cars or any of the other things, that's where the real wealth starts getting made. This is just your foundation. And then you can expand on this like so many of you are doing in the chat. And I love that because that shows the creativity of this group. All of you are like taking what we just did and saying, yeah, but what if I did this? What if I did this and then I did it for my children for their college or my grandkids for their college? Like, you see, your mind gets going. And I just want you to all to know it's endless. The possibilities are just endless. We could spend 5 hours with this one strategy, just taking it into that next parallel with the infinite banking concept. And I think that's where it just gets fascinating. However, we want to stay on time for all of you so that you're not here all afternoon. We do 3-day trainings where you can spend 3 straight days with us where we deep dive this stuff. And we are going to do some amazing 3-day trainings into next year, but that's not for today.
Yep. Kristen, just one thing just to wrap up. So you may be asking, what would this look like if I kept paying the premiums? That's the final thing. It's same policy design. Instead of just letting the dividends and the cash value pay the policy. You know, if you keep putting the 10,000 in, you'll see that, you know, you've more than doubled. Of course, you put more in, but your growth is going to be way better in the policy. And then at the end of the day, we're just like what Chris said, we're going to start using that for paying down debts, investing, financing. But that's the gist of what I was hoping to get through before Cole and the gang got here. And I see they're joining here. So let's
don't not share that. I just got to finish one thing, folks. I want you to look at this. Like the one we just showed you before, we did the 100,000, but then we used cash value and dividends to pay the premium. It's just, I can't understand. And I often have a very hard time logically understanding why anyone would not want to make the $10,000 premium deposits in, because look at the numbers. You know, in the second year, you put 10 grand in, you take 10,410. That'd be like going to your bank, you put 10 grand in and you go back to your bank, you take an extra $410 out. Now that might not get you excited, but the year after that, you take an extra 976 out. And then after that, it's 1,575 out. So you put 10 in, you take, you know, 10,000 plus an extra 1,575. Who wouldn't put 10 grand in something that would give them 11,575 back while they still had access to all that money? So you see, just every year that goes, it just gets better and better and better. So I have a really tough time sometimes when people are like, you know, how long do I have to make these premium payments? That drives me nuts. It's like nail on a chalkboard. I always correct them. I'm always like, you mean your premium deposits? And they're like, yeah. How long do I have to make them? I'm like, why would you ever want to stop making deposits into your bank? Like, why would you stop making premiums? Because look at the numbers. It just gets silly. But hey, there's always somebody that's looking for a quick way out, but they're just not understanding why we do what we do. So I just wanted to bring that full circle, Craig, because we hear that a lot.
That's an awesome point. And, you know, you look down at year 11 when we're just doing the minimum of the policy, which is 5,000, but it grew 13,704. I'll do that all day long.
Yeah, I know somebody else that would do that. It's a company called Infino, and they're creating next level stuff, like literally revolutionary stuff. And they know the numbers on these policies. They know what they do, but they've got a grand vision for what they're doing. Now, we're going to be talking more about Infino and all about what they do and my involvement there. But today we're going to just talk about something that I did that I think is just unbelievably valuable, and I wanted to bring it to all of you, or have Cole and Jackson bring it to all of you, because it is totally free. There's no strings attached here, folks. This is something they're doing, kind of, you know, in life, you got your give. You know, when you give, you get. This is what they're giving. They're literally doing something, and you'll understand. I'll call it the enterprise value, but the true value in this, because it is a major problem. Let me just give one story, and then I'm going to introduce Cole and Jackson on this. You know, my grandfather many years ago passed away, and I'll never forget it. I was a financial advisor, so my family had me come in, and they said, hey, Grandpa had lots of life insurance, but we don't know what he had. and they just hand me a bunch of shoe boxes. Any of you relate? How many of you had a situation where literally you're just handed a shoebox and you're supposed to figure it out? I spent days and days and days with grandma and dad and mom, just going through all these shoe boxes, trying to find policies and doing all this. And, I'd find a policy. I'm like, oh, I found another one. And then I'd call, oh, it's lapsed. And I'd find another one. And, oh, it's just an accidental, accidental death and dismemberment. And I just kept going. But the thing that I'm trying to get across is none of you will ever comprehend how much life insurance death benefit is never paid out because somebody bought a policy when they were younger, lost the contract, misplaced the contract, it got put in a shoebox, and nobody did the work to find it. And that policy, which was meant to provide a legacy or pay for a funeral or pay for something, never, ever gets paid out on. Well, that's going to stop. And what they're going to talk to you about is exactly how you can prevent that from ever happening for your family totally free. Cole and Jackson, I want to turn it over to both of you and just let you guys have the floor.
Thanks, Chris. Jackson, I'm gonna let you rip here. I just got to say really quickly. So thank you for having us. Amazing to be here. Whatever Craig, Stephen, and Chris were telling you to do about making your premium payments, do it. I do it. I own 14 of these. I don't sell life insurance, proper life insurance, but I have 14 of these policies, and I can't wait until I'm 70 and still making my premium payments. Those are gonna be the best days of my life. And I'm like a user of this system. And it's actually what I did is I had an exit, 7 or 8 years ago, and I had an infinite banking practitioner said, I didn't know anything about it. He said, you got a problem. You have too much money in your checking account. I said, thanks. His name was Richard. I said, thanks, Rich. I go, what do I do? He's put it into life insurance. I'm like, thanks, Rich. Like, I thought he was joking. And then he handed me a book. I read the book, eventually found people like Chris on the internet, started watching their stuff. And I went, oh my God, he's not wrong. I got to do. And so I put all my money into life insurance. It took me forever to do it. And a lot of pain, a lot of blood, a lot of urine, a lot of underwriting. But I did it. And then I wanted to create a financial technology company. And I needed money to do that. So I went back to my bank, my life insurance policies, and I took the money out. And I made money and I put it back in. And I go to report my net worth now. Sure, my business looks good, but my life insurance policies look better. So anyway, yeah, he's not wrong about those premium payments. I love to hear people say that. That's just such a brain-breaking thing. And it was for me when I first started. But just follow the math. Make your premium payment. Like everyone wants to sell this product like, oh, eventually one day premium offset and it'll self-sustain. And everyone looks forward to that. I look forward to when I can continue to pile capital into this thing. All right, I'll stop. I'm preaching to the choir, I think, but these guys are not
you're
wrong.
right. Like I'm right where you're at. I think I have 14, maybe 15 with my daughter's couple of policies. But like every year when I put the premium deposits in, like I know that I'm taking more out than I just put in. And it's just an unbelievable thing. It's, I get those back in the day when life insurance was life insurance, I'd get the premium notice to pay the premium. Like, darn it. It always came at the wrong time. I was always hesitant. I'd always wait the full 30 days to pay it. Now I get that thing. Literally, I get in my office the next day after opening that mail. That's the first check I'm writing. It is the most exciting check I'm writing. And a lot of you don't understand that, but that's what Cole was just saying. You will get to a point where that will be exciting to you. And you're like, I'll never be excited about making a premium payment to an insurance company. Oh, yes, you will once you understand what this is and the math behind it.
And I'm glad, Cole, that you shared that because we've got a lot of people that are new to the event. And, we didn't ask you to say that. I just love that you brought that up because we have a lot of new folks that are learning this process as well. And to hear someone that's a user of it as opposed to us who are helping people set it up, I think it's really powerful because it's pay your premiums. Absolutely.
Yeah. It's free. I just think it's free money. I mean, I just basically, look at a year where it kind of breaks even. And then I looked at, well, if I don't put money in, I have less free money. If I put more money in, I get more free money. But all the money I put in, I can just take right back out 100% of it. So it's anyway, and there was a whole period, and Jackson, I'm going to let you rip on infino, but there was a whole period I'll just give you what I've been doing with it. And I don't sell this stuff. I'm not a financial advisor. This is not financial advice, even if it were. But what I personally did with it, I'm in tech. I'm a big fan of Bitcoin. And I basically used my policies after I started Infinio. I still had a lot of capital. Like I had quite a bit of capital in these things. I started to dollar cost average. Every time I'd make a premium payment, I would just dollar cost. I take the money right back out and buy Bitcoin and just dollar cost average into Bitcoin. I bought the top of Bitcoin for the last 6 years. And holy cow, like you think about what I own now, I own Bitcoin now, but yet my Bitcoin has a floor because of the cash value, the life insurance ticking up literally every day. And then if Bitcoin ever goes to zero, my family was like, you should have never bought that Bitcoin, Cole. Well, okay, I'm dead, but they get all my death benefit. So they're like, somehow are going to think I was brilliant either way. So like you can't lose. I'm not saying buy Bitcoin. Well, even though you probably should, but I'm not a financial advisor, and that's not financial advice. That's just what I did. Okay, Jackson,
And
uh,
on that note,
let it rip, man.
with what we're doing at Infinio, it's really similar to what Cole is kind of talking about with using life insurance as an asset and what you guys were talking about previous to our conversation. At Infinio, we're using technology, namely blockchain and AI, to make life insurance into a global asset class. And so by using the ledger that Chris was talking about earlier, that is the first step into actually being able to use your life insurance as the asset that it was always meant to be. Instantaneous loans, being able to buy and sell it at will, and much more features that we will get into. But really today, I have a video that I would like to show everyone that really gets into the ledger more in depth around the benefits and also showing you how you can use it yourself to digitize the policy and prevent that sort of shoebox situation that Chris described earlier.
So what we are doing is we're offering a free service. There's no catch to it whatsoever. If you, we offer you the opportunity to essentially digitalize your life insurance policy, and it's free. When you digitalize your life insurance policy, you receive essentially an NFT. This is a highly secure document. It's actually more secure than if you were to not digitalize your policy. We at our company have a gentleman by the name of Tony Garcia, because this is the number one question that we get asked is if we digitalize our policy, is my data or my policy secure? Having turned it turned into a non-fungible token, and I could spend an hour explaining what a non-fungible token actually really is. But think of a non-fungible token or think of a non-fungible asset. When you hear this term being floated around, a non-fungible asset is just simply an asset that's very unique and bespoke and can't be duplicated or replicated. So that's all that non-fungible really means, non-fungible asset. Now, when you have a non-fungible token, it's a digital version of that non-fungible asset. That's all it is. And it works really well with blockchain because blockchain is a source of truth. It's a source of truth that can't be tampered with. So the point is that your data is very, very secure. Our Chief Information Security Officer, Tony Garcia, works with the likes of the CIA, the FBI, etc. So your data is secure. Let's just kind of get that out of the way. So by digitalizing your life insurance policy, the first thing that we guarantee is we guarantee you a system that allows your beneficiary to 100% receive the death benefit. This is vitally important. Currently in America, there's over $7 billion of what's called stranded death benefit. If you can imagine, those are checks that people put a lot of time and energy and money into ensuring when moved on generationally in their family and sits in a government escrow account. Essentially, it's terrible simply because they can't find the person, or the person, the life insured, didn't even know mom or dad or uncle or aunt had a life insurance policy on them. There's a whole myriad of reasons that this happens. So this is what happens is by digitalizing your policy goes up. It gets held on something called the provenance blockchain. The provenance blockchain is our blockchain of choice because it's the most secure, institutional grade financial blockchain in the entire world. The largest financial companies in the world use the provenance blockchain because of its security. Your life insurance policy goes up there. All your information is redacted out. It's held there. And through simple CRM, client management data, your policy is then dripped back out to key people designed around when you want that to happen.
Imagine this. Your life insurance policy isn't just a document tucked away, but a living asset, seamlessly accessible, verifiable, and most importantly, secure. Welcome to the Infino Ledger, a free community-driven software transforming life insurance as you know it. The Ledger doesn't just safeguard policies. It's a place where members verify their human identity in an ever-growing world of automation. By joining, you confirm your identity not just as a policyholder, but as a member of a broader community built on transparency and trust. Up till now, you've engaged the Ledger as a way to digitize your life insurance policy and to ensure your loved ones receive the death benefit. In the near future, you will be able to borrow your cash surrender value, trade your life insurance policy, and get paid a reward token called the Infi token. Here, you're not merely storing a document. You're storing into a secure, people-powered ecosystem that recognizes the true value of your life. Every life insurance policy on the Ledger is digitized, secured, and stored on the blockchain, creating an unbreakable link between you and your legacy. No more digging through filing cabinets or worrying about lost paperwork. In fact, with billions in life insurance benefits going unclaimed, our Ledger ensures your family receives what they're owed when it matters most and serves as the gateway to the broader Infino ecosystem. Let's begin by logging into the Ledger as a life insurance policy owner. You'll start by providing an email address and clicking on the sign in button, which will send a verification email to the email address. Clicking on the link in the email will instruct you to return to the dashboard where you'll see your personalized Ledger homepage. Setting up your profile is quick and easy, ensuring you have a seamless experience. Upon your first login, you will land on the settings page. Here, you can update your personal information and turn on notifications for verification of life, as well as edit the cadence of those verifications. Don't worry, we'll explain more about this in a little bit. If you are a life insurance agent or broker, you can select the toggle here and gain the ability to digitize your book of business. On the main dashboard, you can see an overview of your policies. Notice the Dr. AI Bob feature, an AI-driven assistant ready to answer your questions, such as how much paid-up additions can I purchase this year without making my policy a modified endowment contract or MEC. We're still refining this feature for optimal security and privacy, so while you have access to AI Bob, it cannot yet interact with specific policy data, but it's a glimpse into the future of interactive policy management. Let's digitize a policy. Click on Digitize Policy and upload a document to be stored. The system allows you to manually enter information from the document, or you can try out our automatic data extraction feature, which you can verify and edit if necessary. This ensures all details are accurate before you create your digital record. Once confirmed, hit the Mint button to create a digital record. Your policy is now securely stored on the blockchain with a unique identifier. To be clear, all that is being placed on the actual blockchain is a hash of a few key details of the policy. This is an encrypted fingerprint of your policy, which allows the blockchain to uniquely identify your policy in our ecosystem. None of your private data is placed in a readable form on the blockchain. Now, let's dive into the details. The system presents a clear illustration of your policy's cash value over time compared with your premiums. You can sort this data or copy it for further analysis. This section also displays a detailed breakdown of your policy, including any loans or changes you've made. We're working towards integrating with carrier application programming interfaces known as APIs for automatic updates. For now, any changes made in the Ledger or with your carrier must be updated here using these buttons. Rest assured, our priority is maintaining the highest security standards to protect your data. Once a policy is digitized, the Ledger will make sure the death benefit is claimed when the time comes. This is done through an attestation system. The policy owner will receive emails on a cadence of their choosing, such as monthly, quarterly, or annually. In the event the policy owner is unresponsive, we will ask community members to attest to the insured's life. This is where those verification of life settings that I mentioned earlier come in. The policy owner can set how frequently they want to verify their life and how many times those can be ignored before we ask community members to verify the life of the insured. In the event that a community member confirms the insured is no longer with us, we will send information necessary to make a claim on the policy and instructions to do so, resolving the stranded death benefit problem. If you want, you can have multiple community members and have the ability to prioritize who is first to verify your life and for how long before moving to the next community member. The Ledger isn't just a tool for individuals. It's also a powerful asset for life insurance agents and brokers, transforming the way they manage and grow their client relationships. This not only helps agents digitize their portfolio, adding value when it's time to sell, but provides their clients a seamless insurance management experience. To get started as a life insurance agent, you would log into the Ledger as shown before. Upon logging in, agents need to switch their account to an agent account in the user settings. Once done, they can access their client management system, a robust interface that connects them to all their policyholder data and settings. This dashboard allows agents to navigate seamlessly across different client profiles, upload policies for their clients, access policies their clients upload, and monitor policy activity in real time. One of the first steps in the agent workflow is client onboarding. After selecting the Client tab,
The agent begins by sending a unique link to their clients that allows them to create their ledger accounts and receive consent to upload policies for them. Once the clients consent, the agent can proceed to digitize and mint the policies onto our secure blockchain system for both themselves and the policy owners to track and manage. Agents can either manually enter client policy information or use Infinio's automatic data extraction tools as we've previously described. This step simplifies record keeping while allowing agents to keep a digital blockchain secured policy for each client. After verification, agents finalize the process by minting the policy. This step encrypts key policy data into a secure hash, which is stored on the blockchain as an identifier. This blockchain storage ensures a unique, unalterable record that enables agents to manage policies with transparency and security. Once policies are digitized, agents have access to Infinio's suite of management tools. These tools allow agents to provide clients with insights on their policy's performance, including the growth of cash values and cumulative premiums. They can also model different scenarios, such as potential returns or loan options. For questions about policy features, agents can rely on the Dr. AI Bot feature, an AI-driven assistant that helps answer technical queries and provide quick support. This feature can assist with general inquiries about policy types, coverage, and cash management, although it doesn't access client-specific data to maintain privacy. Thank you for exploring the Infinio Ledger with us. This isn't just a tool. It's your gateway to a secure, people-powered ecosystem that recognizes the true value of your life and legacy. From individuals digitizing their policies to agents revolutionizing their client relationships and books of business, the Ledger transforms life insurance into a living asset, seamlessly accessible, verifiable, and secure. As introduced at the beginning, the Ledger isn't just about digitizing policies. It's about affirming your unique identity in a world driven by automation. By joining, you're not only safeguarding your legacy, but becoming part of a broader community rooted in trust and transparency. Every policy digitized is a testament to the most non-fungible asset of them all, human life. Looking ahead, the Ledger will expand to include innovative features such as a marketplace to buy and sell life insurance policies, instantaneous lending against your life insurance policies, and reward tokens like the implied token, further enhancing the value of your life insurance policies. Whether you're here to secure your family's future or enhance the value of your life insurance today, Infinio is committed to streamlining, securing, and supporting every step of the journey. For more information, visit our website or contact our support team at ledger@infinio.ai. Join us in redefining what life insurance can achieve, because your legacy deserves nothing less.
Wow. How freaking cool is that? What everybody think? Like, just think of it like Cole and I, like we have 14 plus policies. Like without a system like that or some type of a management to figure out the growth of our entire private banking policy, like all of our policies, our private banking system, we'd have to individually calculate it, put it into a spreadsheet. That system, when I loaded up all my policies, it basically gives me a household look. Here's how much cash value I have. Here's how much death benefit I have. It's just making things so much easier, and it's totally secure. And I know no matter what, if I die tomorrow, nobody has to search for these policies. So you don't need to be like, honey, come on in. Let me show you where all the policies are held. And hey, if anything happens, here's who you call. You got 17 different people you have to call, 17 different forms you got to fill out, which none of that'll change. But you follow what I'm saying. Like it's one place, and nothing gets lost.
That's phenomenal, Chris.
I appreciate that, Chris. Yeah. And one of the features, so a lot of people kind of say to us, well, you're doing this for free. Why are you doing it? Well, I'll explain why we're doing it for free. There's a whole bunch of features. So once we get the world essentially to digitalize their policies, and you can see where the world is going, this most recent election result is leading us called down the crypto path globally very, very, very quickly and very efficiently. Thank God. The way that Infinio makes money off of this is by now offering participants and people that have digitalized and joined our community and our ecosystem features that will make profit on. One of them is the ability to take a policy loan. So instead of charging you an interest rate, we will charge you a flat rate. We'll charge you a quarterly fee, which will be a fraction of the interest rate that you're currently paying either at a bank or through the life insurance company. So the interest rate that you'll pay on the loan that we give you will be zero. Now you have real control and predictability of your capital, because let's be honest, interest rates are unpredictable. And we believe through whatever we call this infinite banking or, leveraging life insurance or banking with whatever you want to call this strategy, the more control, the more predictability, and the more certainty we have, the better. So that's how Infinio will. That's the first product that we're going to be launching in early 2025. And the mechanics of it are through, and I'm not going to get into all the weeds of it, but just if you're wondering like how we can do this, it's through stable coins and through automated market making, essentially. And I won't get into all the weeds of what that is, but I just want to give you a little bit of either financial or technical information that lends well today that wasn't available, 6 months or even a year ago. And now because we have US regulators in favor of this, we can do this completely in the daylight. And we will now have regulators chasing us versus us running away from them. So this is very, very favorable.
I love Boyd's comment. He said, so instead of finding a CV line of credit, which is, a line of credit issued by a bank, we could leverage Infinio for a similar capacity. Yes, but remember, I don't know if you heard Cole say this. If you go to Boosie Bank, one of the CV line of credit providers that are out there, the one I use, they're 7% right now. Okay, so imagine if Boosie called me up and said, hey, Chris, we really like you. We're going to give you your loans for 0%. How would that change my game? What would that do for my spread? How would that help me make more money? I mean, it's stupid for me to even say that, but like that's effectively what you're going to be able to do in the future with Infinio. I mean, I think there's going to be a fee, but I don't know how that'll work, but it won't be an interest rate. So you'll literally be able to use your cash value at 0% to borrow it. So your cost of capital now, for the most part, goes to zero or very close to zero minus the fee. And now you get to use the money in your policies the same way you do now. And you can use them multiple ways. You can use them, on the blockchain, which I think in the future, that's just going to be the norm. But today, what you would do is you'd take it, from the blockchain, turn it into USD, and then turn it into fiat, dollars, and then lend it out. But again, like we're seeing into the future, but we got to still recognize where we're at today. And today we use fiat dollars for all the stuff that we buy and do. But in the future, it won't be that. So, there's kind of just a mindset shift. You got to think, okay, here's how it works today. We exchange dollars, but in the future, we might not use dollars. All of you use a credit card. And what you're not realizing, and that is that similar concept, you're never exchanging actual dollars. You're using a credit card, which is, I'm not going to say digital dollars, but it kind of is. And that's what the future will be. And that's what we're talking about here. And this system is literally going to take what we do and open infinite banking concepts up to the world. And the other thing that's really exciting, and I'm glad you mentioned it, is we have a lot of clients that for one reason or the other, something happens and they've got a policy that they no longer want. They can't keep it anymore, so they're going to surrender it. This will give a marketplace for those people to then take their policy, if it's already on Infinio's ledger, like they already have the info, and they can say, hey, I'm thinking about selling my policy. What would you give me for it? And then Infinio and their team would look at it and then make, I would assume, an offer. Again, I'm speaking a little out of line here with how I'm saying this, but make an offer on your policy. For us, that's going to be a game changer because it drives me nuts. Just the other day, sorry to tell stories, but I had a great client of mine. They fell onto some hard times. They're a real estate investor. Things just aren't going the way that they were, and they just can't keep their policy. We've tried everything. We've looked at mode changes, dropping PUAs. They're just at a point where they just have nowhere to go. Now, their policy is one of the old golden gooses, the 4%ers, the guarantee 4%. That's like literally like, think of the finest bottle of wine you could find in the world. That's that. And he can't keep it. And, like somebody would buy that thing in a heartbeat because it is such a great policy. Now there will be a marketplace for that. Sorry if I left anything out.
Well, Chris, I think the other thing just to add into that picture is with what Infinio is doing, we've got some insurance companies out there that treat loans differently. Some reduce dividends when you take a loan, some don't. But this normalizes all that stuff. We don't care anymore at that point because we're not actually taking the loan from the insurance company, right? We're taking it, from the Infinio side.
Yeah,
so
that's so right, Craig. Like what Craig is referring to is something that I learned the hard way when I first started doing this. I had policies with direct or non-direct, and honestly, today I can't even remember what the difference between the two. One is direct and one is non-direct. And if I was taking it from a policy loan from the wrong one, I would lose momentum in the dividend tied to the direct or the non-direct. And and so, I've went on a mission to just try and simplify, heavily use technology to simplify this super valuable. It's like this is the most valuable strategy, but yet so convoluted and misunderstood because the life insurance industry, literally, what I have learned is the life insurance industry literally keeps it complicated as a way to keep us out. It's a gatekeeping exercise. It is way too complicated. So it's like, how would you ever know? Oh, I need to know if I have a direct or non-direct, and what impact does that have on the dividend if I take a policy loan? Like, what do those words even mean?
Yeah.
Right? Like, how are you supposed to understand what that even means? Well, the thing about technology and AI is that you don't need to. You just do it because it works and it gives you a result. And it's just all that back end stuff is just thought out already for you because people like Chris and Craig and Steven, they understand how to do it right. And so what we're doing is we're building a product essentially at a very high level that just does it all for you. There's no bells and whistles but we know what you're trying to do. We're just using blockchain and AI to do what it is that you're trying to do, so you don't need to think about it.
One other thing too, Cole, I got to ask over here. Edgardo asked a good question. So who
Oh, yeah.
owns the ledger, and would the government be able to track the net worth of individuals? One of the nice things we have with policies is they're kind of off record. They're private. Like the government really doesn't see the policy unless it was subpoenaed or they got it. So once it goes into the ledger, does it still maintain that private nature that it does
Yeah.
now, or is it even better?
More so, better. You're totally abstracted. Jackson, why don't you go ahead? This is your meeting. I'm babbling away. I just get excited. I get with Chris and I get excited. So, Jackson,
Well,
why don't you answer that question, please?
Yeah, so I typed in an answer to you, Edgardo. And just to go a little deeper, essentially the data that would be used to identify your personal net worth is stored off-chain in a highly secure database that's overseen by our Chief Information Security Officer that is up to date with federal agency standards, Fortune 500 company standards. And so none of the data that would be able to be used to identify anything personal about you is publicly available. That's stored in an off-chain database that is only accessible when you take actions that would need to pull that information. And even then, that information is not available on-chain publicly.
Yeah, so thanks, Jackson. That's a good explanation. So we own, to answer your question, who owns the ledger? Infinio owns the ledger. And would the government be able to track the net worth of individuals? Not unless you wanted them to. If you wanted to report your net worth, say to the government or to a bank because you wanted to get a mortgage or something or a loan, then yes, you could report it very efficiently, actually. And because this is all verifiable data, this is the one promise of blockchain is that you can't, once you mint something on the blockchain, you can't go back and change it. So this is the idea of not having to trust the truth in a lot of ways. Now, I think I understand the context of your question, which is the real answer is no. They wouldn't have de facto exposure to your net worth or the value of your life insurance policies because the on-chain data, as much as on-chain data is public knowledge, there's nothing on-chain that ties your name, your social information to this. You are basically all your information is abstracted into a highly convoluted hash of a key. So there's no way that they would. Now you can go like currently right now, Infinio has. You can see if you go to the Provenance blockchain, you can see that Infinio has TVL or total value locked of over $300 million. So we've minted essentially and uploaded over $300 million of life insurance value to the blockchain just even in the last few months. So to say that this is popular is an understatement of what we're doing. It's actually given us the ability to say that we're the fastest growing real world asset tokenization company in the entire world because of the adoption of this. But that's all you're going to see. You're just going to see basically the total value locked, the number, and everything else that you're seeing is like encrypted into a bunch of data that no one will be able to understand.
It's kind of funny, like when Cole first presented this to me and kind of started talking to me about the vision of this, because back then it was kind of more vision than it was reality like it is today. And I remember I had a hard time grasping it, but the more I've been around this, and it's kind of like, folks, you know, when you get a red car, if you ever, or whatever color car you have, or a specific model, and you buy the car, and then all of a sudden, when you're driving, all you see is the red car, the same car you have. You're like, oh, there's another one, there's another one. How come I never saw these before? You did, but you didn't notice them. Well, since I started understanding this and seeing the future of where all this is going and the potential for bringing, you know, R. Nelson Nash's concept of the infinite banking concept to not just the United States and Canada, but to the world, and not just doing that, having a method that would literally give an alternative option for institutions, an alternative to treasury bonds. I started seeing this stuff. That's where it got me. Like, you know, they have this coin they're creating. I think, was it called stable coin? What's it called? Litecoin now?
Litecoin, yeah.
Litecoin that literally will rival the treasury without the risks of treasury bonds, rival treasury bonds, I should say. I started to see the future. And then as I started doing more of this, and I was one of the first ones to upload my policies into the ledger on this side. And, you know, I know a couple of you also did. I believe some of you did. And now I start seeing this whole thing, and it just like little by little, like little blocks keep getting put onto this thing. And I start seeing a much bigger future of where this is, that it almost gets to be hard to believe that some people think that everything with what we do is going to remain as it is today. It's really hard for me to imagine that that's even possible, that things will remain how they are today, where we just keep using fiat dollars, taking loans from insurance companies, and doing everything the old-fashioned way. You know, when I look at this, and I had a very unique call with a smart gentleman yesterday. You all will be able to hear that interview, Justin Goldston. He's got more letters after his name than I think any person I've ever met. Just brilliant, too smart, but he's in this space, blockchain, metaverse, AI, and he's telling me, he's like, Chris, nothing that you know today will be the same in 5 years.
Yeah.
And I said, there's no way. 5 years is right around the corner. He says, mark my words. Nothing that you're used to today will be the same in 5 years when it comes to money, how money is handled, and all this. And he's right. And what you're building with Infinio is exactly that future that I'm starting to see. So thank you for coming on and presenting this. And folks, we put that link up in the chat. So if any of you are interested, it's a very simple process. I mean, if I can figure it out, you can figure it out. Don't even tell me you can't, because I suck at trying to do this stuff. So go on there, check that out. The link's there. And, you know, if any of you want the video, you can check the video out again, just to kind of get the grasp, show it to your spouse, your significant other. Jackson, if you want to just post the video up there in the chat, or I can always email it out. But with that being said, Cole, Jackson, Stephen, Craig, anything else you want to add before we close this sucker down?
No, thanks, guys. You know, just there was a comment about just freedoms. You know, will digital currencies provide freedoms or you know, less freedoms in the chat? And you know, it's understanding really what this is. It gives you liberty. It gives you an autonomy. It gives you control. Digital. So there's a difference between central bank backed digital currencies, which take freedoms away from you. And then there's real crypto, things like Bitcoin and real world asset tokenization, which give you freedoms. It gives you autonomy. It takes inflation out of your life. You allow to keep your money in place by wrapping it in all of the stuff that Chris and Craig and Stephen coach, you know, and teach. So, you know, I beg you, I implore you, please adopt what Chris described, because the next 5 years is happening in our lives, whether we like it or not. And you have an opportunity, an exponential, like 1 in 1,000 year opportunity right now to get on the right side of it.
I agree. All right. With that being said, folks, thanks for joining us for this episode of the Wealth Webinar, the last one of 2024. I want to wish all of you and your families a Merry Christmas and a Happy Holiday. And also, the next time you'll see us, it's going to be 2025. So that 5-year clock is a ticking. We'll see you next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.